Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, Director of Investor Education here at PassiveInvesting.com. And with us today, I have a very special guest, Tenny Tolofari. Tenny, welcome to the show.
Thank you so much, Whitney. How you doing?
I'm doing great. Happy holidays. We're recording this right after Christmas 2023.
Absolutely, absolutely. Hope you had fun.
Yeah, you too. Well, I know we have a property to talk about today, 101 Elwood, 140 units in Baltimore, Maryland. But before we dive into those details, tell us a little bit about yourself, how you got started in multifamily investing and where you're at today.
Thanks, Whitney. Thank you so much for having me on the show. Me and my partners have been a fan of the Multifamily Nation podcast. I've been interviewed by Dan in the past as well. And Dan is one of our mentors. I'm excited to be here again to kind of have a conversation about who we are and the deals that we've done. And hopefully your audience can benefit from the information I share today. Well, my name is Tenny Tolofari. I'm one of the co-founders of Excite Capital. Is a Maryland-based multifamily syndication company. So we have three partners, Dr. Julius Oni, Leslie Awasom, and myself. I'm the director of acquisition. Leslie is the director of operations, and Dr. Julius Oni is the CEO of the company. So three of us formed the company in 2019. Right now, we've been able to grow our portfolio from zero. Dan knew when we bought our first deal, so now we have about $168 million of asset under management. And I'm looking forward to sharing with you one of the deals we did last year. Last year we did about $60 million worth of deal, raised about 30 million. And one of those deals are the deals I'm going to be sharing with you. And how I got started into real estate. I basically went with the philosophy that Robert Kiyosaki shared in the cash flow quadrant, where he said, if you want to build wealth, you have to build a business and invest in something. It could be precious metal, it could be real estate. He invests heavily in real estate. So I was doing my 9 to 5 job. I started a financial services business where I was selling life insurance. In that process, I met one of my partners that's already doing some form of real estate in the single family home arena. And I told him, hey, maybe we can partner up. And then we started having conversations about real estate. And my goal is to build a business and invest in real estate. So having met one of my partner, Leslie, we decided to come together and form Exact Capital. And in the process, while we were trying to raise capital, our third partner, Dr. Julius Oni, he was interested in investing. And then later he realized that this is a great opportunity for him to be a part owner. So he became one of our partner as well. And that's when the company took off. But I can share some more story about, what some of the challenges we had or we've had in the past, if those are something you're interested in. But that's how Exact Capital came about from zero. And this is where we are right now.
That's so cool. Well, let's dive into the details because as we were talking before the show, 101 Elwood, 140 units in Baltimore, Maryland. We were chit-chatting a little bit and I'm like, okay, just make sure, let's tell the story here. And you were like, oh man, I got a story for you. So I'm excited to hear that. Let's start off with the basics. When did you purchase this property and what was the purchase price?
So we closed this deal December 30th of 2022. We bought it for 25,408,025,000. We raised about $9 million. And this was a loan assumption from Fannie.
Okay. So how did you find the deal? Let's back up the timeline. Was this listed with a realtor? Was it off market? How did you find the deal? How many people were competing with it for the deal?
Actually, this deal has an interesting story. The deal was listed in the market. I think the timeline for folks to bid on the deal expired. And nobody somebody purchased it or had it under contract. And then they fell out of contract. And then the broker reached out to a group of folks that was interested in the deal and wanted us to take a look at it. So we took a look at the deal, underwrote the deal, and the deal penciled. And then we went back and then we now selected about 3 individuals to go to best and final with them. We came second. We went to buy interview call with the seller, and the seller went with another group the second time. And then after a while, the broker reached back to us and said, "Hey, are you guys still interested in this deal?" We said, "Of course, we're interested in the deal," and we went back and we won the deal. So we went to buy an interview call, lost the deal, and then it came back to us. Basically, that's the short form of the story. And we've had a lot of occurrences like that in the past in our career as well.
Mm. Well, so how did you structure your contract? There's so much I want to unpack there, right? Like, first of all, went under contract twice with somebody else, once somebody you were under competition with.
Right.
Comes back to you, right? That's like, just a testament to like stay in the game, stay in contact with your brokers, right? Um, but the seller must have seen something in y'all's group. Like, so how did you structure that contract, where the seller was like, yep, I want to go back to these guys?
Well, the time we bought the deal, a couple of things were playing for us. One is we in April of last year we bought a deal that's similar. It was a 2023 vintage, a bank conversion from bank to multifamily. It was a Fannie assumption. That's one. Two, we had a significant money for earnest money deposit as well. Three, we have the experience doing a similar kind of operating a similar kind of deal. So when we were able to share our experience with the seller and the broker, I think the broker was the one that actually pushed on our behalf, knowing that we've performed in the past and they've been able to have conversation with our references and saw that we'll be able to perform. And that's why they came back to us, because in the interview with the buyer interview call, I think we did very well. But unfortunately, they were looking for somebody that have more experience than us, and they went with another group.
Mhm.
But when they realized that group was not moving, they came back to us and said, "Hey guys, if you guys are still interested, I would like to give you guys the opportunity on the deal." So that's when you came back to us.
Awesome. Okay, so did you have a typical purchase sale agreement, like 30 days due diligence, 30 days to close, 30-day extension? Like, how did you structure that?
Yeah, so we have the typical 15. We had 30, 30, 15. We had a 30 days due diligence period, a 30 days period to close, and then we had an extension in there for 15 days.
And how much earnest money did you put down on the property, and was it non-refundable?
It was non-refundable, $500,000.
All right. And how did you fund that? Was that from the three founders, or was that like raised capital? Like, how did you fund that?
Yes, we usually syndicate our deals, meaning we pull resources from our community. Our investors are mainly medical professionals. So we have a huge group of investors now that we reach out to when we have a deal, and then we raise capital from our investors. Yes, and of course we have skin in the game in every deal that we do as well.
Awesome. All right. So okay, I know you guys had a couple different opportunities to look at this deal. What attracted you to this deal? What was the business plan?
So basically, the deal, one big thing that attracted us to the deal is one, the location. The deal is located in a really good area called the Canton area in Baltimore. It's like 5 minutes away from John Hopkins Hospital. And it's in there's another park called Madison Park. It's a really nice park in Baltimore that people, take their dogs and they go for walk and stuff like that. And it's a Class A deal. And then another important thing about the deal is it was a conversion deal from a school to apartments. And like I mentioned earlier, we in April of last year we bought a deal that was from a bank that was converted from a bank to an apartment, and that deal is one of our best performing deal that we have. Another thing that we looked at the deal was a loan assumption deal. Last year interest rate was beginning to climb, and it was a fixed rate debt, and we were like, you know what, if we underwrite the deal, it works, we can go with it. So a lot of those things, we looked at it, we had the experience managing a deal like that, and a lot of these things just played into it for us.
Awesome. All right, let's talk about due diligence here. You got the property
Absolutely.
under contract. You have 30 days due diligence. You have $500,000, down hard. How did the due diligence, the physical due diligence go? Let's talk about that first.
So the due diligence, the way we do our due diligence, usually we partner with our property management company. In this case, we use the company called WPM in Baltimore. So we worked with them to go into the physical inspection, where we walk all the units. And of course, we do the financial audit as well, where we look at the financial that was provided to us. And this is a very important thing for anybody that's listening. The financial audit is something that you want to really, really pay attention to, in the sense that you want to pay attention to the tenants, which is when I say financial audit, I'm talking about the rent roll that you're having and the trailing 12 months, which is all the expenses. The trailing 12 months shows you the expenses that you have on the property, whereas the rent roll shows you all the people that are paying rent actively on the property. You want to make sure that everybody that is on that rent roll and the money that they're paying is actually what is reflected in your financials. You don't want to assume anything, because if you make any assumption, you might end up acquiring tenants that are not paying the normal or the right amount of rent or the market rent. So we worked with our WPM to do a financial audit. We work with different vendors to do a lot of inspection, because the property is a brick exterior, is brick walls. So we brought in consultants that can help us make sure the brick is in good position, is in good shape, the roof is in good, the plumbing, the electrical, all of those things were in good shape before we went ahead and purchased the deal.
Okay. Were there any surprises that came up?
Yes, we had one. One of the surprises we had was one of the consultants that came in inspected the bricks on the property, and he said it would take us about $2 million to reposition the bricks, and we did not budget that at all. So we went back to the owner of the property and was like, hey, did you guys knew that we need to reposition the bricks? They were like, it's not a big deal. So we had a conversation with the seller, and we negotiated some price out of the asking price. I think they knocked down, is it $500,000 or $300,000 from the asking price from that. But based on what the engineer said, he said it's not a big deal. You don't need to really do anything. But we just use that as an opportunity to go back to the seller. Like, hey, listen, we might have to spend some money because the person that's going to buy the deal later on might come up with the same issue. So that helped our negotiation with the seller.
Yeah, I think that's two pieces of wise advice that you dropped here. One, make sure your financial due diligence, you're underwriting that as strictly as you are your physical due diligence, and also, and I think people do it, operators do it, but you put some words to it. What is your end goal? Eventually to sell this property, and you want the seller, if you can, to take care of any of that obsolescence or structural issues with that end in mind, so you're not on the hook for it. So I love that you kind of connected the dots for people on that.
Absolutely.
Any other surprises that came up on either the physical or financial due diligence? Was there any issues with obtaining insurance on this property?
Insurance was not a problem. One of the huge challenge we had was the loan of the deal. We, for folks that syndicate deals, you want to make sure there are a couple of things that we learned from this deal. One is the bank that you're assuming the debt from. They usually review your company, and they want to make sure your company is not crowdfunding. So by them looking at our website, they saw some information on our website that looks like we were crowdfunding. So that was a big issue between us and the lender. So we had to go back and forth with them to let them understand that we work only with accredited investors, and we needed to provide evidence. We had to provide evidence to them to show them that we only work with accredited investors and we're not crowdfunding. So if you're structuring your website and you're doing 506B or 506C, you want to make sure the information you share is clear on your website, or any information that you share with a lender, that you're not crowdfunding. So that was one issue. Another issue we had with the deal was they wanted us to put some deposit on the property, like a deposit that they can hold on to. Initially, it was $600,000. Over time, they increased it to $1.2 million. And that was another big surprise that we had, because we told them that, hey, listen, we were not planning to, raise an additional $600,000 that you guys can just hold and deposit for the property. So that was another big surprise that we had on the property. So that caused a little bit of challenge, but we were able to overcome it as well.
Well, before we dive into the details of like what you assumed the loan at, what would be an instance or an example of something on your website that, for an operator that's listening, that would maybe be a red flag saying that you're crowdfunding instead of syndicating?
So what on our website I think showed that we were crowdfunding is I think we mentioned that we work with a lot of investors and we advertise our stuff online, right? We do not clearly specify that we work with medical professionals that are accredited investors on our website. So by the information they gathered on our website shows that it looks like we just marketed it to the whole public, and anybody that is interested comes in, and then we're able to get money from them to invest. Also, we did not indicate that our minimum investment is like $50,000 as well. So
gotcha. So
yeah,
just essentially adding more clarity to your website, which it would be amazing for your business anyways.
exactly.
Awesome. Okay, so let's talk about the actual loan assumption. Walk us through the details. It was a Fannie Mae loan, correct? Like, what was the interest rate that you assumed at? How much was left on the loan? Were there any prepayment penalties, lockout periods, stuff like that?
Yeah, so the loan that we had about $19.1 million. The loan to value was 73%. Interest rate was 4.09%. It was a 10-year term. We had 3 years left. Amortization was 30 years.
Awesome. And so with 3 years left on the loan, was there any payment penalty if you decided to sell in 2 instead of 3? Like, were there any lockout periods in there?
No, our business plan was to actually, do 2 things: either refinance or sell after the loan expires. So we were not worried about like any lockout period.
Okay.
Or any prepayment penalty, because we bought the deal about 3 years left. So we're just going to implement our business plan and then exit.
So before we move on to raising capital piece, I'm curious to understand, you're purchasing this property a year ago. We still have a ways to go in the run up of those interest rates. What was your thought process on, were you escrowing any funds for a potential refinance in case you had to go into an adjustable rate mortgage? Like, were you setting aside any funds for, just in case this rate situation didn't settle down in the next couple of years?
Well, a couple of things we were thinking. One was, if 2020, I think that the expiration is 2026. If the loan expires, we can refinance. Now we can get to a situation where the interest rate is super high, and we want to refinance at time, we might not be able to give investors any returns, right? That's one scenario. The other scenario is the interest rate might drop, right? Those are the 2 options. And then we have another option to sell. And like I mentioned, also we have escrow money in reserve with the bank, about $1.2 million. So our goal is we are going to come in, improve the performance of the deal, because this deal was a little distressed. The DSCR was at 0.8%. So we want to try to push it up above 1 to 1.2%. So our goal is to come and improve the management and increase revenue so that we can improve the DSCR. Once we do that, we'll be able to take our reserve that they have, or the money that they have in escrow, about $1.2 million. That's something that we were planning to use to put in our reserve in case, we get to a point where it becomes a problem.
Got it. Got it. All right, let's talk about raising capital in the deal. How much was your total raise, and how did you structure this for your investors?
So total down payment for this deal was $6,230,000. So an interesting thing I'm about to share with you right now is we did a 1031 on this deal. So in December 17th of 2022, we sold one of our deals. And from that deal, we were able to do 1031 of about 3.5 million from that deal to this deal. and then we raise the rest from our investors. So total down payment for the deal was 6.2 million. Closing cost was about 504,000. And then what else did you ask?
Oh, just how did you structure it? Like, returns,
Okay.
and splits, any hurdles in there?
Yes, we have that. I'll pull that up real quick. So total raise for this deal is about 9 million. Our investors return, I think we did 75-25, where investors have 75% of the deal and we, the operators or managers, have 25%. And we have two hurdles. The first hurdle is we have a perf equity where if we hit their pref, the splits changes to 25-35. And then once we hit another hurdle of 20% average on our return, it splits to 50-50.
Got it. Awesome. And how many tranches were in the deal? Was it just one tranche?
What do you mean by tranche?
Oh, just like one, if an investor came in and say like $100,000, they got the 75-25, but if they came in and say $500,000, they got a different, tranche, or was there a pref equity tranche or anything like that?
Oh, I see. You're talking about a different asset class.
Yep.
So we had just one. It's just one class of investors, class A investors, and that's it. Where if you come in as an investor, you have 25%, and then the general partners have 25%. That's it.
Gotcha. And what kind of fees did you have for this deal?
Fees, we had a acquisition fee for closing the deal. I think acquisition fee, we had a 2.5% on this deal. And then of course, main fee that any syndicators get upfront. And then once we go through the process of executing the business plan and managing the property, we have asset management fee as well. And then we'll have a fee at the end of the deal for capital transaction fee as well.
And what were those?
So 1%? I think our asset management fee is 1%, and then our capital transaction fee is 1% as well at sell or refinance.
Okay. Now, this is a question that I usually don't ask because, we're usually holding this conversation pretty quickly after the deal is closed. But since you closed on this deal a year ago, tell us about the first month of ownership. Were there any surprises that came up during that transitionary period?
Yes, there's a huge surprise. There's a huge surprise. So one of the main surprise that we had on the property was the seller of the property did not disclose fully the tenant profile that was on the property. So after we took over the property, we realized that a couple of the units are being used as Airbnb, where somebody is subletting to somebody else and then they're using it for Airbnb. That's one. Two, some of the tenant profile that we had on there were not qualified to be on the property. And then three, there was eviction that was going on, and not a lot of those tenants that were not qualified to be there. Some of them, they started the eviction process, but they did not complete it. So a lot of those kind of caused some issues at the start of the transition. So we had to go in and audit and make sure we kick out all the tenants that are not qualified to be on the property. And then the squatters that we had, the ones that are doing the Airbnb related situation, we had to give them eviction notice as well. And yeah, those are some of the surprises that we found.
The joys of owning property, right? And you get paid to handle the issues, right?
Absolutely. And we work with our property management company. They have an extensive background and experience in that market. So they're helping us navigate a lot of these issues, especially with the laws when it comes to eviction and how to manage some of these tenants, short-term rental, all of these things. They are helping us manage a lot of those very well.
Awesome. Well, Tenny, I have two questions for you as we wrap up. Was there something that you thought was going to be easy during this process that ended up being harder than you thought? And then let's flip that question around. Was there something that you thought was going to be incredibly hard that actually ended up being pretty easy?
I think what I thought was going to be easy was the loan assumption piece. Because we just did it in April with Fannie, I think we used Arbor. Arbor was a company that we used the custodian of the loan, Arbor, and this was PNC Bank. So we were like, well, we've done it. We just did it this year with Fannie. We didn't have a problem assuming the loan. But when we started working with PNC, the underwriter started coming back with a lot of questions about, we crowdfunding, increasing our escrow money, and all of that stuff. It just became a complete back and forth between us. And one very important thing that I did not disclose earlier was we never had a call with the underwriter. Usually when you're assuming a debt or when you're getting new debt, you have a weekly cadence where you have conversation with your debt team to see what's going on, or if they need any document from you. But in this particular transaction, we never had one call with the underwriting team, which was really bad. So we were asking for it. They never wanted to set it up. We don't know any reason why they didn't want to have that meeting. So that was one big challenge that we faced. We had a lot of challenges. This is just some of them.
And of course, that's what you get. That's what the operator gets. How they earn their stripes and earn their income is taking care of those challenges for the passive investor.
Yeah.
What did you think was going to be harder that actually ended up being easier?
What I thought was going to be hard that became easy. I think in this deal, everything was hard because we did a 1031. We were selling the deal. We closed the deal in November, and then we're selling the deal and we're buying another deal in December. So everything was chaotic. But I would just say, I think what part was easy? I think working with the brokers was easy. They made our life easier. We were able to provide guidance on how to navigate a lot of these challenges. Just being able to work with them closely to navigate some of those challenges. I think they were always ready to have a conversation with you, even if it's 8 or 9 p.m. at night. They want to get on a call to try to help you navigate a lot of the issues that we were going through. So I would say that communication with the brokers was the best part of it.
Awesome. Well, Tenny, thank you so much for being on the show today and sharing your knowledge and expertise with us. If listeners want to find out how to get a hold of you, how can they do so?
Well, for you to get a hold of we at Exact Capital, like I said, my name is Tenny Tolofari. I'm the only one online. That's Tenny, and then Tolofari is Tolofari. And my company is excitecapital.com. Excite is X as in xylophone, S as in Samuel, I as in indigo, T as in tango, E as in Edward, capital.com. There you can find everything about Excite Capital there.
Awesome. Well, again, Tenny, thank you for sharing your time and knowledge with us here today. We look forward to hearing about your future deals.
Thank you so much, Whitney, for having me. Appreciate it.